Thanks, Sandra. Okay, so I'm going to talk about some myths of the buy-in and buy-out industry, but before I do so, I thought it would be helpful just to give an overview of the market and where we are currently. So I've got a chart here which shows the volume of business written across the entire sector since 2007 all the way up until the end of last year. And this is across all insurers in the marketplace. And you can see that there's been a general trend of an increase in the volume of transactions happening. So by that, I mean transfers from the DB space into the insurance market by purchasing a bulk annuity. There's been a couple of blips in the years along the way, some years higher than others. And you can see that in 2014 and 2015, there were particularly big years with over 12 and 13 billion worth of transactions completed in those years. And some of those were driven by particularly large buy-ins and buyouts. And just to clarify, when I mean a buy-in, what I mean is a transfer from the pension scheme to the insurance company of some of the risks of the pension scheme. It typically covers a subgroup of members, maybe the pensioners, maybe a subgroup of the pensioners. The pension scheme stays in place. It doesn't go away, the scheme's still there, but the insurer has an obligation to pay to that scheme monies each month to meet the pension payments for those members that it's insured. So typically you look at a buy-in as a first step if you're not ready to do a full buyout. I've got on the right-hand side, some schemes that have carried out these transactions since 2007. You can see that they are some names you'll be familiar with, some particularly large companies. You might be trustees, sponsors, consultants of these companies, and they've done this journey along the way. The one thing to note is, prior to about 2005, there wasn't really this level of activity in the market. It was really only buyouts that happened, and they were for insolvent employers. The landscape's changed quite a lot, and really the reason for doing this now is not really for insolvency, while it can be done for that. It's really as a risk management tool. It's trustees and sponsors using buy-ins and buyouts to de-risk along their journey. So looking at my first myth, a buy-in transaction can only be completed for a large scheme, which is often something that we get asked. In my opinion, this isn't true, and you can get good value from doing a transaction of many different sizes. So I've got here a chart which shows for our company, Pension Insurance Corporation, the number of deals that have been done by size. So you can see that the vast majority are in the less than 50 million range, and this is since 2008, since we started. So just over 70 of those have been under 50 million. You've then got just under 40 in the 50 to 250 million range, and then you've got just under 10, which have been done at the very large end, which is 250 million plus. But what's interesting is it typically tends to be those 9 or 10 large transactions that get the media coverage and the press coverage, and that's what people will hear about. So it could give a false impression that actually it's only large schemes that we are interested in. That's not the case. You can do transactions all across the market. But it is true that size matters, well, at least to some of the insurers. Insurers have got different appetites for different sizes of transactions. I've got here a pie chart which shows the volume of business that's been written across the industry, broken down by insurer. And I'll just go through a few of the insurers and what their typical size ranges are. So first of all, we've got Legal and General. They look at large transactions, but also quite a number of small transactions. So there'll be lots of transactions done at the small and medium end, as well as large transactions. So you can get a quote from them for a variety of sizes. You've then got Rothsay Life. Rothsay tend to concentrate on the larger side of the market. So typically 100 million plus is what they all quote on. You've got Aviva. Aviva tend to look at small to medium-sized transactions, and their size appetites change year in, year out. Prudential, who are actually no longer active in the bulk annuity space in the UK, so I won't dwell on that. Just Retirement Group. they look at the medically underwritten market, and that tends to be at the smaller end of the market. You've then got ourselves, Pension Insurance Corporation. We typically quote on schemes which are 20 million plus. So we won't look at the schemes that are below that, but anything above that we will tend to quote on. And the largest transaction that we've done has been for 2.4 billion. So really across the whole market, we will take a look. Okay, moving on to my next myth, which is that insurer pricing is a mystery. I admit that it's true that insurers don't disclose their pricing assumptions because for commercial reasons and other reasons, we can't do that. But we do understand that trustees and sponsors would like an idea of what insurer pricing is like so that they can know whether their scheme is ready to do this type of transaction if you want to. So what we do is every month we provide 2 consultants who are active in the bulk annuity market, in the de-risking space, with pricing points. So we give them our pricing levels at particular market conditions, and we update that every month. So for example, if you were interested in carrying out a buy-in or buy-out, you can go to your actuarial consultant, they can consult their specialist de-risking team, and you can get a feel for what the price would look like. So that's an easy step. Instead of going out to market and getting a full quote, you can get something very high level by talking to your specialist consultant. But what I can do today is I can talk through some of the fundamental principles that we use to price transactions. So the first concept I'm going to talk about is hedging. Hedging is the removal of the risk by paying a premium to do so. And why would you do this? You do this to remove volatility and get certainty around the cost of your liabilities. As the picture on the right shows, if you've hedged your position on various things, you can nod off for a while, let the world evolve around you, and you're unaffected because you have hedged your position. So the key things that we hedge out are interest rate, inflation, and also longevity. We don't take a view on how long someone is going to live. We let the reinsurers do that. So we hedge out that risk. And what that means is that when it comes to pricing, the way that we price these liabilities is to look at what the market price of these items is. So we look to the swaps market for interest and inflation. We look to the longevity reinsurance market to build our longevity assumptions. And for pension schemes who are doing something similar, looking at a full yield curve for discounting their liabilities, looking at granular setting of mortality assumptions. So for example, using postcode analysis, salary analysis, which lots of actuaries do now in the space, you'll get a similar result for those items than what an insurer does because it's all market driven. But the important thing to note is while hedging is great and you can close your eyes for a while, you do need to check the position every now and again. You need to wake up and check, are those hedges working? Do I need to refine those hedges? What needs to change? Is it still a match position? And we do that on a regular basis. Second concept is investment returns. So as an insurer, we will go out there and we will buy assets to match our liabilities. Now, the assets that we have to buy are very specific. They have to closely match the liabilities that we're holding. So we can't just buy some assets which don't match the duration and nature of the liabilities. They have to be a close match, and the regulations push us to do that. So I thought it'd be interesting to compare the matching in an insurance company of the assets and liabilities to a dating website where you're also trying to find a close match. So in the insurance environment, when you go out there and you buy assets, you have to try and find a close match to your liabilities. Once you find them, you have to hold them. You can't change your mind on those. You have to hold them for the whole perpetuity of those liability durations. On a dating website, when you go on there, you're trying to find a close match, but the equivalent of what you do in the insurance space is on your first match, you go on a date, you get married, and you can never get divorced. You have to hold on to that forever. And that's effectively what we're doing with the assets. So we need to get it right the first time round. So how do we do that? Well, I've got a chart here which shows the liabilities and then the assets that we're using. The black line is the liabilities of a pension scheme. You can see that they increase in the early years as pension increases, increase the amount due, and then they tail off as there are more deaths than pension increases. The colours underneath it show the assets that we could buy to try and match that liability shape. And in the early years, you'll see that there's lots of colours dominated by yellow and red and orange, and that's effectively corporate bond spreads. So we can go out and purchase, with a lot of certainty, corporate bonds which match the shape of that liabilities. And that's great for pension schemes because it means that those assets are yielding above risk-free. We're getting investment returns from them, and we can pass that on through our pricing. At the longer end, you can see that not all of those gaps are filled, and that's because you can't purchase assets at the long end which perfectly match the shape of those liabilities. And where we do, it tends to be dominated by the blue assets, which are gilts, which are risk-free rates. And from a pricing perspective, that isn't ideal because it means that they are low-yielding assets. And so when we put that through to schemes, they'll see less of an attractive price if they're investing in higher risk assets at that longer end. And that's really one of the key reasons why when you come and seek a quote for a pensioner buy-in, you tend to get a more attractive price compared to how you're measuring things, because that short duration pensioner liability is, say, for all the orange and yellow asset returns, because it's the short end of this liability curve. Whereas for longer duration deferreds, we've got very little assets that we can buy that outperform gilts, and so there's less of an investment return that we can pass on. And that's why deferreds could look more expensive than pensioners. But it doesn't mean that we stop there. We try and find assets at that longer term that can yield you something above risk-free, because that's beneficial to both parties. So I've got a picture here on the right, which might look like two construction workers on a site. It's actually two of my colleagues in the asset team who are doing some due diligence on a site in Kent, which is to build some student accommodation. And we ended up investing in this, which is we have invested some money in the building of student accommodation in Kent for the University of Kent. And what that has given us is we will get the rental income from when those students accommodate, are in that accommodation. And that's a rental income that will be paid over a long period of time, something around 50 years. And that rental income, it gives us a greater income than the risk-free rate that gilts would give. It gives us inflation protection because those rents go up with inflation increases. And we've got some guarantees around how many students are going to be occupying that occupancy over that long term. So what we found here is we've gone out and invested in a long-term asset that yields above gilts, and then that's great because we can pass that on into our pricing, fill some of those gaps there that weren't filled before, and get you higher returns than those gilts were showing. So we do try in that area. That was pricing. The next myth is that this is all great, but hasn't the outcome of the referendum put a stop to buy-ins and buyouts? Well, rates did fall to an all-time low following the referendum vote. They went to below 1%. They're negative at some durations. And this is bad for pension schemes who aren't funded fully to buyout, because it means that deficits have risen to all-time highs. But actually, for us as an insurer, we've seen more demand post the vote than there was earlier in the year, and trying to think through some reasons why that is. One of the key reasons is that pension schemes who are invested in gilts, maybe not for all of their liabilities, but for a chunk of those, haven't been affected for those gilts, because while yields have fallen, their assets have gone up because the gilt asset value has gone up. And from an insurer perspective, because they measure the pricing relative to a gilts measure, our pricing still looks attractive relative to gilts. And we're hedged ourselves, so we haven't felt the impact of that. And some schemes actually saw the opportunity to do a transaction just after the Brexit vote, when there was lots of market volatility, and it meant that some of the asset returns that were out there in the market, particularly corporate bond spreads, were at an all-time high. And so schemes that were ready to transact used that opportunity and got some favourable pricing put through during that period of uncertainty. One scheme that we transacted on was the Pilkington pension scheme. They did a 230 million pensioner buy-in with us just after the referendum. They were using gilts to fund that transaction, so the market volatility and gilts falling to an all-time low, they weren't affected by, and some of the favourable pricing that was out there by high asset returns they were able to lock into. And we've seen this continuing trend through the months, August, September, October so far, and there's lots of transactions lined up for the year end. So it's really pensioner buy-ins or schemes that are hedged, that are carrying on looking at de-risking. And my last myth is that an insurance transaction can only be carried out when a scheme is fully funded to buy out. And I can understand why schemes want to do this. You might have a 10-year plan to get to a fully funded status. You might want self-sufficiency at that point. You might want to do a buyout at that point. But there are ways to do this along the way, which means that you can do things as and when it's affordable. I'm going to use a case study to illustrate this. Phillips Pension Fund, around a £3.5 billion pension scheme. Quite mature, about 66% of the liabilities linked to pensioners. The remaining was deferreds. And I've got a graph here which shows their funding position. They've had periods where they've been quite closely funded. They've had periods where the funding position has not been fully funded, and that's because the assets aren't exactly matching the liabilities and there is a deficit depending on when you look at the scheme. There was a desire to do de-risking. They couldn't afford to do a full buyout at the time that they started to look at this. So what they did instead was tranche up their liabilities into stages and do different transactions over time. So they started off in 2013, did a nearly 500 million tranche for their pensioners, and they split this so that it was only the large pensioners that they insured. There's various ways of splitting your pension scheme into different categories. They chose to do it this way. And they did that transaction with Rothsay Life. They then came back to the market in 2014. Their funding position had changed, insurer pricing had also changed, and they sought to do another tranche. And they did another further 2 tranches in 2014, one for 300 million, this time for the youngest pensioners. That was with Prudential. And then they did another tranche, which was of a similar size, but this was across a mixed pensioner population, so small, young, large pensioners, etc. And so by the end of 2014, they had transferred over 1.1 billion into the insurance regime, but they still hadn't achieved fully funded status. Then in mid-2015, while the funding position of the scheme improved, some of the elements for the sponsor changed as well. They wanted to insure the remaining liabilities, so went out to market to seek a quote for the rest of the liabilities, which was 2.4 billion, and that was a mixture of pensioners who hadn't yet been insured and all of the deferreds. And we insured that tranche with them, covering all of those liabilities. And what this really shows is that you can break things down into tranches. You don't have to wait until you're fully funded, and it might be advantageous because you might be able to get different pricing at different times, and also your funding position will change at different times. So if something is affordable today, even if it's only for a small pensioner chunk, it might be worthwhile doing that than waiting till the end when you're fully funded. And that's all I wanted to say. Happy to take questions at the end. I will now pass over to Liz, who is from the Total Pension Scheme, and we've carried out a pensioner buy-in with Total, and Liz is going to share her experiences with you, which I think will be invaluable.
Thank you, Uzma. Good morning, everybody. Nice to see some friendly faces in the audience, giving some support. As Uzma said, I'm going to share with you some of the experiences that we had as a pension fund doing a buy-in transaction for the first time. So I'm going to follow a similar theme as Uzma, and I've picked out some what I think are probably common myths and misconceptions that you might have as a pension fund going through a buy-in transaction for the first time. So first of all, if I put it into context and tell you a little bit about the Total UK pension plan. Technical hitch. Oh, there we go. Not pressing the button hard enough. So the Total UK pension plan was formed back in 2002 following a large merger. It was a time when there was a period of consolidation within the oil industry. The French oil giant Total merged with the Belgian company Fina, and shortly afterwards those two companies merged with another French company called ELF. And what we found is that we had a number of DB pension schemes within the group. So there were 13 DB schemes in total, each with a trustee board, each with an actuary, each with a lawyer, etc., etc. So we thought it was time to consolidate and try and make some cost savings by bringing them all together under one umbrella. But that did leave us with a complex benefit structure, and we had around 40 different DB subsections at that time. Because we didn't go through any benefit rationalisation, as you can imagine, we probably had every possible benefit permutation, or so that's how it seemed. We have assets of around 2.5 billion, and liabilities are slightly more, 2.8 billion. You see we're in a deficit position. We've been in a constant deficit position since 2002. And of course, that's a concern to the company and the trustees. We have around 15,000 members. We closed to new joiners back in 2002, and new joiners since then have been going into DC. And despite opposition, we've managed to stay open to future accrual, although now we're in a position where we only have 800 or so active members, so you can see we are a very mature pension fund. We have a French parent company. They've become more involved in the running of the scheme over the years, and as you can imagine, that brings with it its own issues. And as Uzma said, we did a buy-in with PIC in 2014. At the time, I think it was the second largest buy-in transaction that had been done to date. It covered 1.6 billion of our liabilities and about 7,400 of our pensioner members. So, if I can share with you some of the lessons that we've learned. So my first myth is that trustees can do this on their own. So you may hear what Uzma and I have to say, and you may think it's a good idea for your pension fund to pursue a buy-in, but will you need any help along the way? In our experience, we were initially interested in doing a longevity swap. The company was keen to reduce its longevity risk because that had hit us hard at a couple of our previous valuations. And then there was a comment at one of our investment committees that I remember where somebody said you can do a buy-in transaction for practically the same cost as a longevity swap. And we thought, well, why don't we do that then? You know, we take more risk off the table for practically the same price. So the focus shifted to looking at buying insurance. Now the Total Group is very conservative in its investment approach, and to date all we've held are equities, cash, gilts and property. So the prospect of doing a buy-in was quite a surprise at the time because it was quite a departure for us. But it was quite exciting that the group was looking to expand its investment approach. In our case, the initial project was driven very much by the company, but we knew from the very start that we would need trustee engagement because ultimately this would be a trustee contract after all. So we established a working group to look at this option, and this was made up of representatives from both the company side, the trustee, but also, quite importantly, with representatives from group in Paris. We knew we needed to have their support, and this was invaluable because they ensured that key people within Total were kept aware of developments, so there were no surprises along the way. Also important was the support of our admin team, which was invaluable because they worked very hard initially with our buying consultant looking at our data before the deal was done, and then they worked tirelessly again with PIC after the deal was done, looking at the payroll issues that were identified afterwards. So, overall, it was a very collaborative approach, and I think this was key to the project's success. You're much more likely to get the deal over the line if you have the buy-in from all interested parties. So, in the words of a TV programme that my son loves to watch, the myth trustees can do this on their own, I would say. Come on. Myth busted. Myth number 2. You can worry about your data later. So I'm reverberating a bit. We hear how important clean data is, but is it really necessary to worry about this now? So we underwent a full data cleanse back in 2010, so we thought that our data was in reasonable shape. And ahead of the project, we spent a long time drawing up a very comprehensive benefit specification with the aid of our legal advisors, administrators, and our actuary. I mean, I've already said that the plan is very complex, so we had 40 subsections to work through. And there was lots of head scratching and checking practice with the admin team as we worked through that. We needed to clarify our spouse's information. We knew that it was fairly inaccurate. And what we did is we wrote to all our pensioner members and we asked them to tell us whether they had a spouse or a dependent and how old that person was. And pensioners, bless them, they just love to tell you about themselves. So we had a very good success rate with that. 90% of our pensioners actually wrote in and gave us that information so we could update our database. And it also helped with our subsequent valuation because we no longer have to make that assumption about how much older the spouses are than their husbands or wives. And then, like most schemes, we didn't hold spouses' pension amounts on our admin system. It's the sort of thing you don't need to worry about initially. You wait until somebody dies, unfortunately, and then you calculate those details. So what we did is we made some initial assumptions about what those spouses' pensions would be, and that is the information that we used when initially going to the insurers. But in the end, we came to the conclusion that it was much more beneficial if we did actual calculations for everybody. So our admin team, again, very well for us, they performed all these calculations for the pensioners that were in scope. We worked from the most valuable pensions through to the least valuable pensions so that we could hit the largest liability first in case we ran out of time. And we were able to provide that information to PIC so that they could give us the best pricing for that information. So the work on the benefits spec also identified certain issues in relation to our rules and our current admin practice. So for example, pensions on death. We pay pensioners in advance, and if somebody dies mid-month, we don't claim back that excess pension. But in quite a few sections, the rules specify that the pension ceases on the member's death and we should reclaim the overpayment. We wanted to continue with our current practice, so that was an issue that we could highlight to the insurers that we were keen to provide insurance for. So, I would say good data is key and can have a fundamental impact on your pricing. So get it right from the start. So myth number 2, you can worry about your data later, I would say is definitely another one where this myth is busted. Myth number 3, a good advisor is worth every penny. I mean, you can tell, you embark on a project like this and you know from the very start that it's not going to be cheap. And as this was a major investment decision for us, an uncharted territory, we had no prior experience, we didn't know where to start or what to expect or how long it was likely to take. But we knew that we needed a good consultant who knew the market and the right questions to ask. And we also needed someone who had a good idea of what insurers would be prepared to quote and who would be keen to transact. And this would ultimately save us both time and money. And I think one thing we did learn during this process is that insurer appetite can vary considerably depending on the time of the year, depending on how many deals they've done to date, and also which deals they are currently working on securing. We needed guidance about how to present our data and the format that insurers would be able to work with without unnecessary manipulation. So this avoids errors and also ensures better pricing because insurers have to make fewer assumptions about what you actually mean. And we really wanted the insurers to see that we were well prepared and that we were keen to take this seriously and we were keen to transact, because that would ensure that we got a competitive quote. Again, the insurers can be picky. They don't want to waste their time if they don't think you're serious. So going to them with your data in a good state, showing that you've got the involvement of your superiors, will make them keen to give you a good deal. We wanted someone who was experienced in negotiating with the insurers and who had a positive track record of succeeding in this area. Again, we don't know what levers to pull when negotiating on price, so we wanted somebody who was going to do that for us, and some consultants are just better at doing that than others. Another issue that was important was having a good legal advisor with a good knowledge of insurance contracts. Again, it's not an area that we have any experience in. So my conclusion on this one is that projects like this are never cheap, and getting good advice is paramount to ensure that you get the best price and appropriate contract terms. So I would have to say in this one, a good advisor is worth every penny is, you can guess, can't you? Come on. Myth confirmed. Myth number 4. This will not take over my life. We all have day jobs. We're all very busy people, and we don't need something like this coming along and disrupting everything. And I think you can probably guess what the outcome to this one is going to be before I work through all my points. So anyway, before going to market, we went through this exercise of drawing up this comprehensive benefit specification with our advisors, and that in itself took several months. I've already said how complex the plan is and how important it is to provide accurate information to the insurers. So we felt this was a very worthwhile exercise, and it was also a useful audit for the admin practice. So we were now confident that the administrators were doing exactly what was in line with what we wanted. We had to select a buying consultant. Again, we went through a separate tender exercise in order to do that, and a beauty parade, and you know yourself that those exercises are never quick. Our administrator worked tirelessly for weeks, finalising the data with which we could go to market. They even set up their own individual project team within the admin team in Bristol, and they were great. They focused very well on what we wanted. Then there were extensive negotiations with the long list of insurers who we were talking to before we selected our preferred bidder. And then we had to go through further negotiations with PIC before we were able to seal the deal. And then we needed formal solvency advice from a specialist provider. So the working group was very keen to ensure that PIC's financial strength was adequate before the deal was signed. And again, that involved another selection process. And whilst we had trustee reps on the working group, we needed numerous meetings with the full trustee board to get their agreement. And that involved rigorous training to ensure their understanding, and that in itself took several days. And then as we approached the deadline, we needed to decide how we were going to pay for the deal. So there were lengthy discussions with PIC around what assets they would take from us and which assets we would need. So that involved advice from our investment consultant and more meetings. And then there was also a transition of assets shortly before the deal to match PIC's requirements. There were detailed negotiations around the contract terms with the legal advisors from both sides, so PIC's lawyers and the trustees' lawyers. There were documents like this, covered in red lines. Again, yes, very confusing. And then importantly for us, we had meetings with head office in Paris at the highest level. It literally went right to the ex-com within Total. because we needed to agree how we were going to deal with the funding impact of the transaction. I've already mentioned that we have a deficit, and this was going to add to the deficit. So the trustees were keen to find out how the company would pay for this. They wanted the agreement from the company before the deal was signed that they would pay a substantial lump sum into the plan to deal with the funding impact as soon as possible afterwards. And then just before signing, again, I think this is probably driven by the lawyers, I have to say, there were late nights in the office going through legal documents in order for us to meet our deadline. So, ignoring any work that we did initially on longevity swaps and an initial false start, this was a full-on, intense project from start to finish, and I think it took around 10 months to complete. So I would have to say myth number 4, this will not take over my life. It's definitely myth busted, it most certainly did. Okay, so my final myth is once the deal is signed, that's it, job done. So once the ink is dry on the contract, life can get back to normal, please, can't it? I think I might give this one away as well. There's no time to relax after signing. Phase 2 starts immediately. So literally the day after we signed the deal with PIC, we entered into a detailed data verification period with PIC's administration team. So once they had all the data and started talking to the administrator each month about which pensioners they were paying, who died, etc., then data issues started to come out of the woodwork, and there was lots of phone calls and meetings to decide what we needed to do with that. We had weekly calls with ourselves and PIC and the admin team to identify and resolve all the data issues. And PIC also set up a project board which met once a month and also had trustee representation that had which went through the main threads of the project to make sure that everything was going to plan and that all the key milestones were achieved. In the background, there was also a separate working group established with the trustees' legal advisors to resolve the benefit issues that we'd identified as part of the benefit specification exercise. So in total, there were probably about 25 issues that we needed to resolve. So with legal advice, we were able to decide whether we could clarify those via resolution or whether we needed to make actual rule changes. And then there's not to forget everybody's favourite topic, the GMP reconciliation that was going on in the background with the help of HMRC. And we focused primarily on the buy-in population. So we've just reached the end of our verification period, and I'm really pleased that there have been no major issues identified as a result. I think that's probably because we worked very hard in getting the data in a good shape before we did anything. And all the pre-agreed benefit changes have either been resolved or we've parked them till buyout. And now we're looking forward to possibly doing another tranche of buy-in for the pensioners that we've accumulated since the last deal was done. So this myth, once the deal is signed, that is it, job done. You're not surprised, it's myth busted. So finally then, just to summarise the key lessons that we've learnt as a result of doing this project. Good data is vital. I think enough said on that. I think you must have got the message that that is definitely the case, as is a good buying consultant. And don't be afraid to change if you're not happy. Make sure that they meet your requirements and meet your needs, and don't be afraid to change if you're not happy. Get the support from as high up within your organisation as possible and keep them informed of things along the way. You don't want them tripping you up at the last minute when you're about to sign the deal, because you may miss the opportunity if they start asking questions. Spend time on getting your benefit specification right and identify issues which need addressing at the start, and discuss these with the insurer early on. Don't ignore them and think they'll go away. They will come out. And to be honest, it really helps the insurer just as much as you to highlight these issues early on. Make sure you've got a good lawyer with specialist knowledge and collaborate and work as a team. I found that most important. And be prepared for some work once the deal is signed. And I hope you enjoy those pizzas in the office as you near the finish line. And then the last thing I'd say is that someone once told me that the sign of a good talk is that you tell the audience something that they didn't know before. So I hope that's the case. Thank you.
Thank you very much to both Liz and Uzma. Particularly like the reference to pizzas. I've actually read somewhere that giving your employees pizzas improves productivity more than pay rises. Yes, for those who joined later, we are taking questions both through the web streaming and the app, and of course also in the room. As it stands, I haven't had any questions from either the app or the website, but perhaps there are some in the room. Gentleman there. Please, could you briefly introduce yourself?
Yeah, sure.
Thank you.
Admin manager at the CoOp. Just got a quick question for Liz. You said you rolled out to pensioners to identify sort of their spouses or dependents. What approach did you take at that stage? Did you say it was for the purpose of a buy-in or just general information gathering?
It was just general information gathering, and they were more than happy to tell us, to be honest.
Brilliant, thank you.
Do we have any other questions?
Gillian Evans from Macquarie. A question around your investment strategy. You mentioned it was in terms of what assets you transferred to the insurer. That came up. Did you ever think of changing your investment strategy in the lead up to the buy-in? And would that be something that you'd think that if you looked again at doing something, whether you'd think about doing that to improve the pricing?
We'll definitely look at making sure we've got the sort of assets that the insurer will need as we go through the process. I think the issue that we found is with the buy-in, it's very limiting then on what assets you've got left. We need to generate certain returns, so we're still forced to hold return-seeking assets, which maybe isn't optimal if we want to do another buy-in, so it can be difficult.
Any more? No? Well, I have a question then. What actually happens with members? What do they get told when a buy-in happens?
So once we did the buy-in, we issued a brief newsletter to all our members telling them what the trustee had done, just emphasising that although it's called a buy-in, it was really a trustee investment. So it wouldn't affect them in any way at all. They would still get their pensions paid in the same way and benefits would accrue in the same way. So it was really much more for information, mainly because they may have read something in the press about what the trustees had done. So it was just to stop them asking too many questions, really, more than anything.
Did you have the impression that they were worried or insecure about that?
No, I think once they had the letter from the chairman of trustees, it was quite self-explanatory, and we haven't had any major issues since then.
Okay. 2 questions. First here, then after.
Would you want to go first?
Yes, please.
Is this on? Yeah. Hello, Keith Greenfield. I'm Chairman of Trustees of a couple of schemes. Just a question for Uzma on deferred. You mentioned about now finding more assets that are potentially giving better yield. How do you cater for all the other choices that deferreds have, especially all the freedoms that recently come in as to whether people are going to be there or not? I mean, how do you factor that in your pricing?
Yeah, so yeah, you're right. With deferreds, there are options. Deferreds can transfer out. They can take lump sum rates. We monitor our experience for our book. So we've got 130,000 pension members that we've insured. A lot of them are deferreds. So we regularly monitor the experience of our own deferred population and what sort of take-up rates they're using to transfer out. And we also collect data from the schemes. So when you come to us and ask us for a quote, if you can have some statistics to back up what sort of proportion people take for lump sums, we can use that in our pricing. I don't necessarily see that as a barrier to a transaction. I know that when the freedoms happened, there was this view that actually there could be quite a large selection risk, because lots of deferreds can now take a DC pension all as cash and transfer out. And you're effectively left with deferreds who are going to live a really long time and only the healthy ones. The actual take-up rates for transferring out of a DB scheme have remained relatively the same. There's been a slight uptick, potentially more queries coming through, but actually less people taking it than was first envisaged. I think some of that's because of the level of advice you need to go through to actually take those options. It's not straightforward.
Hi, Ingrid Kirby, Action for Children Pension Fund. Question for Liz. I wondered whether you had many discretionary practices that effectively weren't covered by the buy-in and where the trustees are still effectively bearing the risk and the cost, or whether have there been changes to those discretionary practices as a result?
The main discretionary practices would have been around discretionary increases, and that's something we've decided to park till buyout, surprisingly.
Just to add to that, the way that you can structure the policy is if you're unsure what you want to do with discretionary practices, you can either not insure them now, but then come back to the insurer and at a particular point ask for an updated insurance policy to cover that benefit, but it would be based on sort of economics at the time. Or you can do a halfway house, which is to insure a certain level if you can afford to do so. But that doesn't necessarily mean that you need to pay that on to your members. So you could insure the higher discretionary element. If it's a buy-in, the insurer pays that money to you. You don't need to pass it on to the trustees. You can hold it so that if you ever did want to pay it, you've got the funds available.
And I think the discretionary dependence pensions as well, we got pre-agreed pricing with PIC,
Right,
and then we
okay,
could
so you
make a
did get that
decision whether
priced
we
in.
insured it or not. And I think in most cases we did. We don't have
That's
many, but in cases that we would insure it.
Yeah.
John Ashworth, the Littlewoods pension scheme. Many schemes have done quite extensive pie exercises transferring the inflation linkage on pre-97. So from an insurer's perspective, if we can prove that there is no sort of selection risk, that it's only the ones with ill health have selected the pie, if that can be demonstrated, is that good news for pricing or poor, or doesn't it matter, providing there's no selection risk?
If there's no selection risk, it's good news. Why that is because, as I talked about previously, we hedge out our inflation risk and we use market prices to do that. If you've removed the inflation element on pre-97 and it's flat increasing, that means we don't need to do that hedging, and that reduces the cost for that. The other element is it actually shortens the sort of duration of the liabilities. You're then paying it for a shorter period, and then you can get those higher asset returns to some extent as well. What I would say it's important to do is when you give the insurer the data after the pie exercise, also give them the data just before the pie exercise happened, because otherwise if you give the data after, you've got these really high pensions because you've exchanged pension increases for a higher pension. So when an insurer looks at it, they might see, oh, okay, everybody's really high paid, they're going to live for quite a long time. But actually it's not, it's because you've gone through a process.
I've had a question through the app, which is for Liz. You said you faced no major problems, but what were the common annoying little ones that presented themselves through the process, and what would you do differently?
Oh, goodness me. What were the annoying problems? I'm really struggling to think of anything. I think the hardest part was probably doing the benefit specification, because it was just so complex, and you'd come up against things and you'd think there's just ambiguity in the rules, and you'd just go round and round and round in circles trying to think what it actually meant. So getting that benefit spec done at the beginning was hard. That was quite tedious, to be fair.
And was that also what required the most work?
I would say the most work was around the wording of the contract. That was meeting after meeting with PIC's legal team and the trustees' legal team, just going around the specific terms within the contract. And because it wasn't something that I was familiar with, it was very hard to keep on top of that.
Mm. Do we have any more questions? Yes.
Isa Makumbi from Croydon Council. My question is, you've got a multinational business which has got members across different countries. How do you carry out the transition so that all members are treated equally? because like the French have got different retirement age compared to the British. How do you converge those two differences so that all members are treated equally when it comes to getting their benefits?
So sorry, just to clarify, if you've got pension scheme members in different countries, how do you assess how long they're going to live and the economics for that? Is that the question?
The benefits. So like the French retire at the age of 60, the
Yeah.
British at the age of 65.
Mm-hmm.
How do you split those two so that all of them are treated equally?
So all of the benefit information comes from what the scheme provides us. So if a retirement age is different for different groups of people, you put it all in the data and the benefit spec, and we allow for that. For people who aren't UK residents and living abroad, we take that into account. We've got statistics there for life expectancy, for other patterns. It tends to be quite a few people are not living in the UK.
And for us, the Total plan is purely for UK-based employees, so Total will have other benefits in other countries, but we're specifically concentrating on the UK.
Any more questions from the room? Yes.
Thank you. Pat Maloney, Talent Pension Fund. I was wondering, in the Total scheme, your buy-in was just over 50% of your liabilities. What were the main factors in deciding on that level of buy-in?
It was purely a decision made to ensure all the pensioners that we had as at a certain date. So it was at our last valuation.
I think there was another question there.
John Nester, Independent Trustee, MCC. How many pension schemes and trustees have been surprised on the run-up to purchasing the buy-in that haven't got the scheme documentation in order, and especially of dealing with equalisation?
I'd say that most schemes, do you mean Barber equalisation? Yeah, I think most schemes probably think that their data and benefits are in good order, and they may well be, but once you do a deep legal review and a data review, there are some common issues that come up. Barber equalisation is a key one. So I'd say that before approaching the market, have a chat with your legal advisors as what are the common legal issues that come up at the point of transaction, and make sure that the practice ties in with the rules. There have been some schemes where they've realised that actually the practice wasn't quite as intended and have had to uplift benefits. It's not really, it's interesting because it's coming up because of the buy-in and buy-out transaction, but once you've discovered that issue, it's an issue for the scheme. It just happens to be discovered by this deep dive.
Would you be uncomfortable if there's not a deed in place?
For doing equalisation? That's really one for our legal advisors. It depends on the circumstances around it. I'll give you an example. We had one scheme where there was a deed missing for equalisation, and the way that we addressed it was that they were content that this deed existed. It was, they'd done searches, people's lofts had been looked at, couldn't find it, wanted to do the transaction, thought they could find the deed, so that the way that we dealt with it was we said, okay, we will insure on this basis. You will continue to try and find that deed. If you don't find it, here is the price. If you do find it, then here is an alternative, and you can deal with it that way.
Right, we have maybe time for one more question, if there is one. Otherwise, I would please join me in thanking our speakers again for answering the questions.